Cathie Wood and Ark Invest went bargain hunting this week. They added 3 companies quite constantly throughout the last couple of days. We're going to talk about those 3 companies in this video. Remember, this is an actively managed ETF, which means they can sell and buy each and every day. But of course, as you know, some of these companies are core to their portfolios, have been there for quite a while, and are constantly in the top 10, if not top 5 of the portfolios. So on Friday, we got a report that they added in the Ark K ETF, Tesla, Roku, Roblox, and 10x Genomics. In the Ark W, Tesla, Roku, and Roblox yet again. And in the Ark F, just Roblox. And as you can see, in the Ark F, they sold Robinhood. In the Ark W, they sold Robinhood and Coinbase. And in the Ark K, they sold Robinhood and Coinbase as well. Now you might be asking why they're selling Coinbase and Robinhood. Are they now bearish on those positions? No, remember they have been buying quite a lot of shares of Robinhood and Coinbase when the price was much lower. And again, since this is an actively managed ETF, they can sell at a profit, then use those profits to buy beaten down stocks, for example, Roblox, Roku, and Tesla. So let's talk about the first company here, and that's Roku. Roku right now, one share will cost you basically $60, has a market cap of $8.6 billion. Year to date, it is down 34.73%. If you look at EV to EBITDA price to sales in the next 12 months, EV to EBITDA at 76.8 times, compare that to its 5-year mean, much cheaper. If you look at price to sales in the next 12 months, 2.2 times, not expensive at all. The 5-year mean sits at 8.6 times. If you look at price to free cash flow, that's in the last 12 months, 49.6 times compared to 151.3 times. Now, currently, the average analyst price target sits at surprisingly $83.3, representing close to 40% upside from the price we're at today. If we're looking at the analyst estimates for the coming fiscal years, I mean, it's not a high growth stock anymore, and they're not really expecting it to be profitable anytime soon. Because if you look at EPS, it still remains negative even in fiscal year 2026. If you look at sales growth, will grow 11 to 15% or so year over year in the coming fiscal years. Then if we look at the Roku chart here on the daily, we can see that it is now oversold. We can also see that it has now completely filled the gap here from back in late 2023. Now you might say, what happened here in February? Well, in February, this is when they reported their own earnings report. It was okay, not the best one. Stock took a hit, and then it took an even bigger hit when Walmart announced that they want to acquire a company called Vizio. Vizio also makes televisions. Walmart is also a partner for Roku in the advertising side, plus it sells Roku TVs as well. So the market started to become a bit more skeptical there. Stock took another hit, and now we're back at under $60. Now, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe. If not, we really appreciate that. We're well on our way to reach 40,000 subscribers, so thank you very much for all the support. If you want to support me even further, do check out the link down in the description and in the pinned comment to get a top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, if you needed a small reminder from the last earnings report, it was basically this. Full year 2023 key results. Net revenue was up 11% year over year. Platform revenue up 10% year over year. Gross profit increased 6% year over year to $1.5 billion. But then to me, the most important points here, of course, profitability, but the key metrics here. Active accounts were 80 million. That's a net increase of 10 million from 2022. Streaming hours were 106 billion, up 18.6 billion hours year over year. It's great. Average revenue per user, that was down 4% year over year to $39.92. Achieved positive adjusted EBITDA and free cash flow for full year 2023 ahead of schedule. Then with regards to the outlook, they expect total net revenue for Q1 to be around $850 million, total gross profit $370 million, net income a loss of $90 million, and adjusted EBITDA break even. Now, with regards to Roku, of course, the stock has come down quite heavily in the last couple of months. Year to date, as we've seen, down over 30%. Ark Invest, they have been investing in Roku for quite a while. Yes, the business, some metrics have been doing quite well, but it's all now, I think, about the profitability side of things. Can they turn a profit yet again? Remains to be seen. Of course, a month from now, we're going to get the earnings report. I'm obviously going to cover that on the channel. Then company number 2, they've been adding is Roblox. So Roblox, one share will cost you $37.76, has a market cap of $23.9 billion. Year to date, it's down 17.28%. Here, if we look at EV to EBITDA price to sales in the next 12 months, EV to EBITDA trades at 41.6 times compared to 60.3 times the 5-year mean, and price to sales 5.7 times, so not the cheapest out there, but cheaper than its 5-year mean. And then with price to free cash flow, we're at 173.7 times, more expensive than before. If we look at the average analyst price target, it still sits at $50, representing 32.7% upside from the price we're at today. Then if we look at what the analysts are expecting for the coming fiscal years, here yet again, EPS remains negative up until fiscal year 2026. Yes, we are seeing some improvements, but then with regards to sales, it's a bit better than Roku. We're getting here close to 20% year-over-year growth. Then looking at the stock right now, we can see this on the daily, by the way. We can see that it is under the moving averages, 20, 50, and the 200-day one. Actually, in the last couple of days, it tried to go over the 200 and the 20, got rejected. Maybe we're going to get a chance next week. If you want to look at the weekly, we can do that as well. On the weekly, the picture is a bit of the same. RSI is neutral with some negative momentum, but yeah, again, it's all about getting over those moving averages. All of them are now pretty close one to the other. Then touching back on their own earnings report, I'm just going to touch on the full year results here. So revenue increased 26% year over year. Bookings increased 23% year over year. Net loss attributable to common stockholders was $1.1 billion. Net cash provided by operating activities increased 24% year over year. Daily active users increased 22% year over year. Average monthly unique players were 14.5 million. That's up 17% year over year. Then average bookings per monthly unique player was $81. That's up only 4% year over year. Hours engaged was up 22% year over year to 60 billion hours. Average bookings per daily active users was flat. And then looking at Q1 and full year 2024 results. So for the full year 2024, they expect revenue to come in between $3.3 to $3.4 billion, bookings between $4.1 and $4.28 billion, consolidated net losses between $1.4 to $1.36 billion, so still losing money, but as you've seen, they're improving their margins and cash flow as well. Adjusted EBITDA to come in between $150 to $115 million at a loss. Then for the first quarter, revenue will be between $755 to $780 million, bookings between $910 and $940 million, which means it's going to be down quarter over quarter because last quarter, as you can see, there were bookings over $1 billion, so that was great. And then consolidated net losses between $347 to $342 million, and adjusted EBITDA between a loss here again, $55 to $50 million. So that's Roblox, still a very, very popular game and, should I say, platform, highly monetizable. Yes, their users are becoming older and older as well. Previously, that was a headwind, right? People were saying, okay, as users become older, maybe they won't play Roblox anymore. But right now, they're going, let's say, up market in the ages category, monetizing those as well. And as they enter newer markets, of course, those are maybe less monetizable. But as this platform grows and grows, as there is more advertising coming into the platform, more games, more monetizing tools, I do still believe that this can be quite a big winner. But of course, a lot of people are just looking at the profitability metrics without actually looking at the free cash flow metrics. Then moving into the last company here, and that's Tesla. Of course, Tesla, we've talked about it quite a lot in the recent days. All those videos will be in the top right corner. Right now, Tesla, one share will cost you $171. Market cap of $525 billion, has a forward PE of 57.7 times compared to 102 times for the 5-year mean. EV to EBITDA 31.1 times, price to sales 4.9 times, price to free cash flow 102.5 times, PEG ratio 5.6, so quite expensive, a huge jump here as well. Of course, we know that this year is not going to be the greatest year unless they come out with some huge surprises, but we know that earnings is going to get hit. If we look at the average analyst price target, that still sits at $196.1, representing close to 19% upside from the price we're at today. Of course, 2-3 weeks from now, actually April 23rd, we're going to get a big earnings report and earnings call. If we look at what the analysts are expecting for the coming fiscal years, again, fiscal year 2024, bad year, EPS down 8.3%, year-over-year growth for sales, not even 10%, but then we see a reacceleration top and bottom line, 20 and 15% year-over-year growth for fiscal year 2025 and 2026 respectively. Then with regards to EPS, 41 and 19% year-over-year growth for fiscal year 25 and 26. Now with regards to the stock, we've seen this already countless times. It's still in the downtrend that started back in November 2021. Yes, recently $160, $165 or so has been some kind of support line. Back then here, when Elon was selling heavily to buy and acquire Twitter, the stock was under heavy pressure. Market wasn't great either. Stock went all the way down to around $100. Could we revisit that? I don't know, but if earnings is very, very bad, guidance isn't good, then yes, you could definitely expect the stock to get hit quite badly. But then on the flip side, if we hear some positive remarks with regards to the take rate for FSD, which of course helps the bottom line, then maybe the market will suddenly turn into a more forward-looking one and say, okay, you know what, earnings are coming down, but since the take rate for FSD has increased by, I don't know, maybe they're going to use the word meaningfully, that's good enough for us, and the stock might react positively. I don't know, this is just a guess. Now going back to the Cathie Wood and Ark thing, so Cathie Wood here retweeted a post by Sawyer Merritt talking about the Reuters story, which basically talks about the Tesla's low-cost $25,000 car and the robotaxi were always going to be based on the same platform. They were going to be very similar, but the $25,000 version was going to have a steering wheel. Maybe Elon and the team have been so impressed with how good FSD12 has performed and were maybe thinking they should be shifting even more resources to the robotaxi FSD effort. That doesn't mean that the $25,000 car is cancelled. Again, they share the same platform. To which I go here to Tasha, which talks a lot about the valuation for Tesla, right? Their price target, the ranges, the bullish side here is $2,000 per share, talking about how robotaxis will account for roughly 2/3 of Tesla's future enterprise value, which you can see right here. Tesla's prospective robotaxi business line is a key driver, contributing 67% of expected enterprise value and 64% of expected EBITDA in 2027. The bear, bull, and expected value here is on the screen. Bull TC's $2,500, bear TC's $1,400, and expected value $2,000. Again, these are their expectations. They have been wrong on a lot of things in the recent years. Tesla has been one of the things where they were right, but let's see if they were right on that again. I think robotaxis, in my opinion, maybe in the United States will come sooner than expected, but worldwide, in Europe, China, and other markets, I do still think that we still have quite some time left, which is why I do believe that canceling a compact car will be a huge, huge mistake. Again, compact car in the United States is maybe not that popular, but in Europe, China, and India, for example, a cheap, affordable EV is a must, in my opinion, and I don't see robotaxis happening in those markets anytime soon. Maybe China, but then you need to have a China-based FSD, which is probably what they're working on right now as well. Might be also why we're getting those 8.8 Dragon Year hints from Elon. Remains to be seen, but overall, these are the three companies they've been buying lately: Salt, Robinhood, and Coinbase. That's all for me in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.